This is eSec Lending Insights. Let's get over to our episode. Well, this is exciting. The four of us haven't been together in a little while. Mike, Mark, and I attended ISLA Americas a few weeks back. I would have loved to have podcasted right after that conference concluded, but it wasn't possible. We were all a little too busy and people were off to the next trip and to the next activity and adventure. It's been a few weeks, but I thought we would get together today. Maybe we can post game on that conference and market trends and dynamics that we were tuned into there. But meanwhile, Jim, you've been doing a bit of a world tour throughout Asia and then most recently the Middle East. So I'm sure you have a bit to share to supplement what we were all doing in Florida.
Yeah, I've been traveling. We did Hong Kong and Singapore. Mark Wilson, Ed Oliver, myself, and Ben Reeder, who trades in that region for us. It was a great trip. The regions are very excited. They always are, and it's always been a high revenue market, a high revenue region for eSec and other lenders. And the excitement now seems greater than it had been. And I attribute that to South Korea coming back. If we remember back prior to the short sell ban, so we're going back kind of early COVID days, maybe even before that. I can't remember exactly how long there was some sort of short sell ban before the full short sell ban came in place, but that market's huge, big revenue generator. It was the largest market outside of China for a long time. Then the ban hit and Taiwan took over as top in the region. I think that's flipping back from what we heard from most in that region. Not everybody's open yet in South Korea.
I was going to say, do you have a sense of market participation?
Yeah, there's
size and
four large primes that are driving business there thus far.
Right.
In terms
so demand to borrow, there's four big counterparts in the market.
Yep. A handful of others as well, but those four are kind of driving that market.
Okay.
And I think others that aren't in today for various reasons will be in soon, whether it's Q1 or Q2 of next year. That market's going to continue to grow. And I think the clients, the hedge fund side, have come back in, but it took a while. Much of that short flow is driven by quants in the region, and quants trade off of data. And there was no data on April 1st. They needed 6 months under their belt to say, okay, yeah, we can trade off this data. We're at that point now, and you're starting to see an increase. Even since we've come back, our Korea book is up 20% in terms of on loan.
From the last few weeks?
Yeah,
wow.
yeah.
So successful trip.
Thanks for noticing.
So you did a good job. So you told us about the demand side. What about the supply side and lender participation across the market? Do you have a feel for that?
A little bit less clarity there than on the borrowing side. There's a handful who still aren't in, both on the agent lender side, and some of the beneficial owners whose agent lenders are open are not back in the market for various reasons. Don't know how much that changes over the next 6 months or year, but I suspect the handful of agent lenders who aren't in the market will find a way to be in the market, driven much by client demand, lenders who want to lend in that market, much like the brokers who are going to come back are being driven by the hedge fund side and their client base that's saying we need in that market. It was noted by a number of folks that South Korea is now becoming a bigger market for them than Taiwan, which is interesting. But I think it's healthy. It used to be as Korea goes, the market goes, and that obviously changed during the short sell ban, but we're going to get back to that point soon.
How much of it is Korea gaining relative strength versus Taiwan also losing some momentum for independent reasons?
I would argue that Taiwan is losing a little bit of momentum because of South Korea. So it's just a focus switch. I don't think there's geopolitical happenings that make Taiwan less of a good short than it was months ago. I think it's really just time and resource split now that South Korea is back. Those two and China are the three widespread high revenue markets in the region. Everything else is significantly below it when it comes to the amount you can make. I just think hedge fund clients are focused on Korea more than Taiwan, and so you drift a bit there.
Hey, Jim, how much of that focus you think is attributed to the strong performance in the cash market? Kospi's up almost 75% year to date.
Yep.
Obviously, in the face of a short selling ban being lifted, so I think it can dispel some of that narrative. Do you think focus is going there because longs have performed so well?
It probably hasn't hurt. I think it would happen anyway, even if the market were kind of flat over the last 6 months. Like I said, it's quants that drive that market. So it's long short pairs. So they're net neutral to market generally. And having higher stock prices means some are probably overvalued more so than 6 months ago. So definitely contributing, I suppose. But it'd probably happen anyway. Accessing China was still a focus for that region. They do it via swap mostly, and then a little bit through P notes where those who can't participate in swap might tend to go. So there's still a desire for more offshore supply for China and ways to monetize that. We had a lot of discussions, not much different than last year's trip and not much different than PASLA last spring in terms of conversations around China. It's kind of migrated from single name discussions. So let's do a single name swap, a single name P note. It's more around baskets now. So the breadth of supply seems to be more important, or at least that was a takeaway my crew had. The rest of the region is still steady as she goes. A lot of talk about how strong Hong Kong's been because of all the placements and CB issuance. I think there's expectations that's going to continue. Hong Kong for us has been a great market in our discretionary. We're seeing good demand there. And we've had some recent auctions where the bids we received were more in line with the elevated revenue we're generating in discretionary. It didn't look to us like folks wanted to pay us out performance for the coming year because of the uncertainty as to whether, if you think about Hong Kong specifically, you can classify placements as deals. The way we look at it in the US is we have a core book of business for directional shorts, and then you have deals, and you really can't count on those deals on a go forward, and borrowers don't pay for them in the way of premiums and exclusives generally. It's more about the certainty. And so I think they're taking the same approach in Hong Kong and to a lesser degree in South Korea. We have had some success in South Korea with exclusive placements. I think we need more borrowers to get paid that premium we're used to and that we'd gotten paid prior to COVID in that region, and what I think that region is deserving of in terms of premiums. So working through that, but all positive developments, I think.
All right. Do you want to give us a quick Middle East recap before we do the Florida summary?
Yeah, Middle East for our client base is limited in terms of markets that are open. We're obviously open in Saudi, and there's some hope around Dubai as being an open market for us on a go forward. But outside of that, there isn't much activity, but that market is really busy. The banks, we visited Dubai, Abu Dhabi, and Doha. All three cities have boots on the ground from almost every bank, which surprised me a little bit. That region is really hopping. And I think over the next 5 or 10 years, which would be your career, Brooke, not mine, that region is going to become a big focus as those markets open up to foreign investors. It had a really good feel to it. I didn't know what to expect in terms of equity lending and shorts and short markets. So
the amount of hedge funds that have relocated to the region is pretty intense and continuing.
That's probably why the banks are there, right? Following the client base. But I was pleasantly surprised. So it was a good trip.
So you think your career doesn't have 5 to 10 years, or you think mine only has 5 to 10 years? Was that an over or under, or how should I interpret that?
I meant it as in my career is shorter than yours. And by the time that region develops, it'll be in your career and mine will be over at that point. I would love to work for another 10 years.
That's my timeline as well, Jim.
I will say I met our largest fan of the podcast.
Really?
In region. Yeah.
Did you, is there some sort of like trophy, medal, plaque, prize, giveaway? Like, did you do anything to honor the biggest fan?
Unlike you, I don't think of myself as the podcast. I think of myself as part of a team. And I would bring it back to the team before making awards. This had a meeting with these folks a number of times. Number one fan referenced our podcast and our yellow shirts and different things from the past couple of years. It was really impressive.
Did the number one fan have a better memory for the podcast than you do?
Oh, most certainly did. Yes, absolutely.
That's amazing.
I told them I might mention our number one fan comes from the Middle East.
Well, good. I love to hear that. It's nice to know someone's listening. So thank you.
That checks one of our, 28 countries?
Yeah, I think it was 27, whatever the Spotify recap was. Just on Spotify, though, keep in mind.
Oh, okay. Anyway, that checks one of the region boxes for us. So very good.
Good. All right. Okay,
let's hear about
what questions do you have for the rest of us, given that you missed out on the ISLA Americas conference this year for the second time in a row? We got to figure out your travel schedule, Jim, so that you don't have as much conflict going forward.
Huge FOMO for me this year, which was unexpected. And so I think I'm going to attend next year for sure.
Can I tell you what I actually learned at ISLA Americas? My biggest takeaway was that I should no longer have FOMO, and instead I should have JOMO, which is the joy of missing out.
Oh.
Yeah. I just sort of felt like it puts it in a different light and gives it a positive spin, makes you feel better about the decisions you're having to take by not joining for whatever you can't join for. So you should have had JOMO.
That's impossible.
That's because you're no joy.
I thought Jomo was Jim of missing out or something.
I thought it was going there too.
But anyway, back over to you, Jim. You can have the floor.
I'd love to know what the vibe and the main themes were down there from both the equity and fixed income side. I would guess the vibe is the same.
I can kick us off. I think probably this year, more than others, the themes were pretty correlated and tied to one another. You have a dozen or so meetings each day, and there was probably some key takeaways and things that were brought up in each. RWA and ways to make assets look more attractive, both on the equity and the fixed income side, is definitely top of mind as regulation and balance sheets and capital, all constraints are weighing in. So I had a lot of conversations around which distribution methods and different structures banks are looking at in general, whether it's asset seg or pledge back. Various banks are putting resources and staffing in one model over another. I thought that was a big theme. Obviously, the timing of when the conference takes place, you start getting into the fourth quarter and year end, and all year end type trades tend to be trades that are balance sheet friendly, nettable trades from the borrower's standpoint. Obviously, different basis trades and different swaps trades starting to become popular and starting to widen out as well. So we talked a lot about various non-cash trades, financing really equities, everyone looking for US dollars against equities, hitting various NSFR, LCR, different kind of funding metrics. So a lot of takeaways from the meeting was how can we get more cash and how can we get more treasuries in, and with existing borrowers, then trying to get documentation up with maybe guys that we don't have in place already. That's definitely a big takeaway. That was a big theme the entirety of this year. It gets heightened around year end, and I don't think that's going to go away anytime soon. I do think there's more of an emphasis on year end, at least on my side, in repo markets. A lot of technical factors in play, making repo markets maybe a little bit more volatile, and market participants are used to and are comfortable with. For the first time in a while, you had the Fed kind of reference it, and there's some technical factors or technical adjustments that they can possibly make to eliminate some of the stress in funding markets. It felt like we've gone a couple of years in this abundant reserve environment where we always felt there was a bit at a reasonable level in the post-COVID world, and it feels like for the first time in a while it's starting to reverse itself, and you're starting to see things kind of gap out a little bit. So I think more now than the last couple of years that there's a lot more eyes on funding markets. It's having a lot of people remember the 2019 kind of tightening in that market and reference that as a playbook going forward. A lot of eyes are already on year end. We've now been back a couple of weeks from Florida, and we've gone through another month end CAD year end. We've seen some bumpiness in that as well. Not really from a flow perspective, more from a level in repo gapping up. If you're looking at different basis, Fed funds so far starting to print 30 plus basis points apart. That's not the norm and not how that market should react. So just getting more eyes. Repo tends to be a overlooked part of fixed income markets. And I think, it's important and pivotal to the functioning of the treasury market in general. And for that reason, I think people are paying more attention to it.
Mike, I didn't hear anyone ask you if you could do more of the downgrade trade with them.
There was an ongoing joke that everybody should wear hats down those conferences that say we should do more, because that tends to be the outcome of a lot of those meetings, right?
Is that the new how you doing?
It is the new how you doing. There's still plenty of that as well, though.
Well, it's just sort of the evolution of time and space for this industry, maybe.
As stock loan transforms into securities finance.
Yes, exactly. It's sort of the more sophisticated. We should do more.
How you doing? Turns into we should do more downgrade structured trades.
Mike, a new collateral set that someone offered up. I know a couple of years ago, we put some CLO trades on the back of conversations at the conference. Anything interesting in that context, or, maybe not having a new collateral set, but is anyone asking for any tweaks to existing schedules that you think could have some value add for Benny owners?
Yeah, for sure. I think CLO is a good place to start. I think you're seeing issuance pick up in that space. So you're seeing the other side of the trade onboarding new clients looking for financing. I think they tend to run a matchbook on them. It tends to be a product with a wider bid ask. So they like to borrow them in at one level and they can offer them out at the other. They can run it through tri-party schedules and tri-party shells that tend to have investment grade corps or other things on them. There was a big focus on that around the conference as well. I think the part of the market you're seeing pick up is the pretty high grade, high rated stuff. BSL loans and middle market loans, probably the ones that people are most comfortable with and understand the most. Some of the real estate stuff will probably get left out of scope, at least in the agent lending community. That was definitely a theme. I know ETFs are picking up as well. We've heard that a lot, of adding ETFs to our existing collateral schedules and widening our concentration limits and acceptability to do trades that are purely ETF financing. I think today, if we take the main index on equities, we'll just mirror them with ETFs, and is kind of more of a fill to existing shells. You're hearing more people looking for outright straight ETF financing. And I don't think that's surprising. I think we've talked a lot internally about, was there more ETFs now than there is equities? So I think that jives with that. That was one of our takeaways. How can we broaden our schedules and get some of our clients into some of these trades as well?
Is there an advantage to differentiating between saying it's only ETFs? Are you going to get paid more versus saying it's ETFs and equities? Like, why would you limit what's in there if it's priced the same?
It would be more of a technical tri-party setup thing of how much you can allow per one ETF compared to one equity. It's a little bit limited on that side, but in theory, the pricing's probably going to be the same. It allows for more stability of trades going forward. Right now, around year end, everyone's looking for these trades. So I don't think we feel like there is a lack of opportunity to do main index equity repo or downgrade trades. But 6 months ago, when valuations were lower and markets were overfunded, that would have been a nice add to our collateral schedules on top of equities, right? Equities were going down 10, 15, 20%. We were getting tapped on the shoulder asking, hey, what are other guys doing? Are they re-rating you lower? Are they pulling back trades? Because they were overfunded, but they didn't want to lose the trade because they didn't know when markets inevitably reverse like they did. They don't want to be caught unwinding funding and then they need it again. So I think in April, May, that would have been a nice lever to pull in our back pocket of having full ETF schedules up. It would reverse quickly. But I think it's more of just another mechanism to make sure that we're getting the full demand of that trade.
Makes sense.
So, Mark, how much of the same themes were you hearing on the equity and corporate bond side in your discussions? Was it all sort of funding related? Was it all capital and capital mitigations, strategies and solutions, or what was the focus of your meetings?
Yeah, there's enough of that. Regardless of product, people are managing to the same constraints. So there was definitely enough focus on year end, and certainly the capital mitigation products that you referenced to. One piece of context for that is these conversations are so fluid and they're happening anyways. You almost don't necessarily need the conference to kick them off. I think for people already participating in capital mitigation products, you're already having that dialogue. For other counterparties, it was maybe a way to initiate the conversations, but you need such a broad group for those. It can be challenging for those conversations at conferences.
So what's the value add of spending 3 to 4 days with meetings solid back to back and making your head spin with your follow-ups? What's the differentiation for the conference in those meetings and conversations?
Yeah. So I think what we've seen is stocks are way up since Liberation Day, and everyone's having a fairly good year. We hear that on the quarterly results regarding equity sales and trading. Everyone's having a good year. One of the major changes has been increased tech spending. People are looking for more efficient and fully automated ways to distribute or borrow stock. So, I think the conference, we heard like in the past, maybe things are a bit more conceptual, but, I think that now there's more being put into practice as far as ways to drive automation, create efficiencies, reduce breaks, things like that. So that's one of the things I'm probably most excited about on the back of this. Some of the funding trades weren't a focus, and there's definitely some good opportunities that come out of it. I just think that some of those conversations are more fluid. I guess what surprised me more so was the amount of focus on vendors and tech opportunities.
I think I echo Mark on that. None of the themes in our meetings were surprising. You went down to the conference knowing you were going to be talking about RWA, structured type trades, how to get more dollar funding against a different collateral set, expanding collateral sets, and kind of way to be more nimble and flexible. All things that it's fluid. We talk about on a daily basis with our borrowers. Maybe the meetings are just more of a formal setting, face to face, talking through progress and where you are with that effort.
So, Mark, I don't know how many meetings you had, but let's just call it 20. Maybe it was more than that, but whatever the number was. If tech was a big focus of many conversations, how much consistency was there in those conversations. I think the problem, Jim and I have done a bunch of podcasts over the past couple of months with different vendor tech solutions, trying to understand what it is, what it does, how it might solve for one thing, what might be the alternative product offerings out there, things like that. And there's a lot of option right now for market participants in our seat. And it's great that sounds like there's more focus and budget spend being put towards tech and new automated solutions. But if everyone's doing something different and there's not consistency across the market, that's also challenging, or could be challenging if it's not all connecting as it needs to on a one-to-one basis. Was it sort of all over the map, or did it feel like there was any consistency of message?
Sure. Yeah. No, it's probably both at the same time, which is a terrible way to answer that question. There is a ton of different solutions available, whether things are being developed in-house or being bought. It does create some organized chaos in the sense that you're trying to meet people in the middle, and you might be using two different native technology for your in-house solutions, and then you're trying to meet in the middle and connect pipes. That can be challenging, but the most consistent part, or the part that makes me excited, is that there is generally a ton of development happening. So whether it's existing products getting better, smarter, or faster, or it's new products effectively filling gaps. And I think that the hard part a lot of times is getting off the ground, whether it be new development or new spend. The easier part, or the part I'm more hopeful about, is when you're nearly fully built, you meet in the middle and you find a way to leverage automation. If I have a tool available and a counterparty has a tool available, it just comes down to focus, then we'll put the time and effort into it to leverage the automation, right? Because the hard part is getting that new system. So I think this is obviously something that's going to be challenging to measure a year from now, even, but I fully expect, and I heard from a number of counterparties that I know already lean heavily into automation, that they expect, XYZ function to be fully automated, or the resource hours on the desk to support something to come down by 50% because this is going to be automated, things like that.
I have a quick question. Do you get the sense from the borrowing community that they want to do more business with less counterparts, or is diversification across the borrow base still important to them as it has been in the past? Just curious if that came up in any way down there. It feels to me like the former is the way it's going. The folks are picking counterparts and not as focused on doing business with 25 different lenders, but rather concentrate that business in less. And so I guess it might be a different answer for both Mike and Mark.
I can start. I think it's a little bit of both. I think it's depending on what book of business you're looking to do. I think in some of the non-traditional financing space, whether it's term funding equities, term funding CLOs, or corps, I think diversification is still key because these borrowers are going to have a constant need to finance. If you get too heavy to one and for some reason something changes on the sense of their book and they have to pull you back trades, I don't think they want to be too heavily exposed there. And they want to make sure they have other counterparts to offload the financing to. And the way to make sure that somebody will be there to increase someone else's decrease is to already have pipes in place. Because if you give me zero of that trade and then you say somebody pulled you back 500, I'm not overly incentivized to help you out there. But if we have a constant balance and then you have a funding need, I think there's value in that. I think it works both ways too. We're trying to diversify our borrower base for that exact reason. Markets are fluid, especially in this market. You don't want to be on the other side of moving an axe from a borrower, right?
Yeah, that makes sense. How about you, McNeil?
Yeah, so this is really probably how I'm spending a lot of my time at conferences. I think that loan balances are being commoditized by borrowers. And I think that's really important to understand. There's a value prop that's certainly mutual that needs to be obtained. And it's my job to find borrowers where they appreciate eSec's ability to scale certain trades that they find important, whether it be the funding trades and the year-end trades that certainly are top of mind right now. Those make a lot of sense. I think there's a lot of value placed on hard to borrow supply when you look at the performance of a stock like CoreWeave this year. For lenders that have a lot of retail stock, it makes sense to scale your hard to borrow book with them and lean into automation for those types of trades. So I think that's really what was my primary focus, finding ways to scale with our value prop. And I think, Jim, to your point, borrowers ultimately will do business with the same amount of lenders, but they're not going to do every trade with every person. They're going to pick out certain trades to do with certain borrowers, because a retail book of stock is going to look really different than a sovereign wealth book of stock. So I'm trying to pick two extremes to make the point, obviously, but I think that's where the focus is. Not to do every trade with everyone, probably to do, you still want to have a diversification of counterparties like Mike referenced, but it's going to be, what's my best way to scale? Where's the mutual value prop with each borrower lender combo?
Yeah, appreciate that.
How
Good.
do we make it less of a commodity?
How about you, Brooke? What's your takeaway from down there?
I had the pleasure of joining these guys for a handful of their counterparty meetings, heard a lot of what they just shared, but also had a lot of opportunity to spend time with a bunch of the beneficial owners that were in attendance. And even though I often focus on this and probably sound like a broken record when it comes to beneficial owners, I think it's exciting that that conference did really embrace beneficial owner participation in a meaningful way this year. There was a nice increase in buy-side participation at the event. I think that will grow in the years to come. I think as this market has continued to change in terms of the types of events that bring the industry together, this ISLA Americas conference, I know it was the largest, well-attended event yet with around 650 people. I think it will continue to grow because I think it's going to bring in more of that segment of the market. And I think you'll see more coverage and participation from the street side and the bank side to look after the buy side participation. It's great to see everyone attending that event. It will grow much like the European ISLA conference has been for the past number of years. I mean, it's had a similar growth trajectory with great participation from the buy side beneficial owner community as well. So I think that's one of my key takeaways, which I'm excited about. But yeah, it was a good event. We missed you, Jim. So next year, hopefully.
Total
Jomo.
Jomo. Yeah.
Jomo. Okay.
Jomo.
We're all suffering from JOMO.
All right. Thank
Good.
you. Thanks, friends.
Thanks, everybody.
Thanks.
Thanks for listening. And now for our disclaimer.
This material is for your private information and does not constitute legal, tax, or investment advice. There is no representation or warranty as to the current accuracy of, nor liability for, decisions based on such information.